Hi, your tutor Hafiz is again with you, and in this session we are going to talk about standard costing and basic variance analysis. So let's get started. First of all, before actually I move into this session, just a little bit of information. This chapter is not in the syllabus particularly, okay? This is a knowledge gap. We are going to bridge up this knowledge gap from the previous paper F2 to get our ideas focused around F5. In F5, what is in the syllabus is the advanced variances. Advanced variances are in the syllabus, which we are going to cover in a separate session. Okay. In this session, we are going to talk about some of the knowledge bits which a number of people have learned already in paper F2, but because some candidates come through the exemptions, they join ACCA through exemptions of F1, 2, 3, sometimes 4 as well. Okay, so in order to facilitate those candidates, this session we have designed. Okay, and also those people who have done paper F2 a while ago, maybe a year ago, 6 months ago, 2 years ago, that would refresh their basic knowledge. Okay, so this is like a refresher session which would cover standard costing and basic variance analysis. So please understand these things which are going to help us to understand advanced variances in a more comfortable way. Okay, so let's start our session. Standard costing. Standard costing is a parallel system to the normal or traditional accounting systems. Traditional financial accounting systems work on the basis of actual results, meaning to say, if you are working as an accountant somewhere, you record all information into your financial accounting system, which is actual information, meaning you record or you insert actual invoices into the accounting systems. You do not book future invoices, or you do not book invoices from the last year or year before, but you do book the actual invoices for sales. You record actual purchases which have just happened in this year. You record actual expenses or expenditures of this year. That's the traditional financial accounting system. Whereas standard costing system is a parallel system to the traditional accounting systems, which records estimates. Which records expectations or expected results. So standard costing system does not record the actual information to start with. It records standard, estimated or expected results into the accounting system. Okay, so this is the idea behind the standard costing. Now let's understand few bits and pieces. A standard is a benchmark measurement of resource usage set in defined conditions, meaning to say that we expect how much of resource should be used in the product or service. Meaning to say, if it's a manufacturing organization, we define an expected benchmark is like a target. Benchmark is like an expected anticipation, that we anticipate how much of material will go into a product, how many labor hours will be used in the product, and how much of the overheads will be used in the product. So a standard is the benchmark or expected resource usage in the product. Okay. Standard costing is a system of accounting based on predetermined costs and predetermined revenues. Okay, predetermined means expected. We calculate in advance before anything has actually happened. And why do we do it? Because they are used as a benchmark or target to compare the actual performance with the expected performance. And when we compare the actual performance with the expected performance, we get a useful feedback. Feedback is like a variance. We find out whether we spent more than expected cost or we have spent less than expected cost. Okay? And then it can be used in performance evaluation as well. Okay, so in performance evaluation, we use the standard costing system as part of the performance evaluation part of the syllabus area D. Okay, so we compare the actual results with the standard results, and the difference is called as the variance. This difference is called as variance. And if variances are favorable, it means we have achieved better results than expected. If the variances are adverse, it means we have performed poorly as compared to expected results. Now, standard costs can be prepared using either absorption costing or marginal costing. Now, here is one thing before I move into it. I will repeat this information again as well, again and again. Whenever we consider standard cost, okay, please remember whether we are talking about standard material cost, standard labor cost, standard overhead cost, standard sales, etc. Standard simply represents the value of material, value of labor or overheads or revenue or sales per unit. So standard is a benchmark for one unit. How much money will be spent to produce one unit? What would be expected cost to make one unit? What would be expected selling price to sell one unit? So standards are always written for one unit. Please remember this. Okay. Now here is types of standards which you had studied in paper F2. There are three basic types of standards. There are three main categories of standards. As I said, remember, standards are expected results. Standards are estimates, standards are benchmarks, standards are expectations or targets. So idea is, when we set targets for the managers, when we set expectations or anticipations for the managers, what do we expect? Number one, ideal standards. In the ideal environment, we expect from our managers that everything will be under the perfect working conditions. Meaning to say, we expect that every member of staff will get into work in time, no delays. Material deliveries will arrive in time, no delays. Machines will never break down, perfect ideal conditions. There will be no loss or wastage in materials. There will be no idle time or poor efficiencies from the workforce. So ideal standards are those which assume perfect working conditions, that there will be nothing wrong which is going to go in the future. Okay. Idea is this: why do we consider ideal conditions? Because ideal standards are like missions, long-term missions. They are set for long-term organizational objectives. That today we may have a loss or wastage in materials. Today some workers may not come in time. Today some material suppliers may delay the deliveries due to bad weather or any other reasons. But long run, there comes a day, I don't know, 5 years time, 10 years time, 15 years time, we are trying to head towards ideal conditions. Okay, that if workers are late by 5% today, how can we make it to 4% in few years? How can we make it down to 3% in another few years, and so on? So these are long-term strategies of the organization, that in long run we want to bring our organization from this point to that point. Okay, the variances to be calculated under the ideal standards approach are generally adverse or demotivational, simply because nobody is perfect in this world. Okay, we can try all our best, but being a human, and probably very weak human, I may get off sick as well. I may not be feeling very well every single day. I may not be highly motivated every single day because of my family, my work, my other related issues. Okay, So materials may be wasted because accidents do happen. Okay, out of 1,000 people working in the factory, something may happen. So because ideal standards assume perfect working conditions, so if we set our standards on the basis of ideal conditions and then compare with the actual results, variances are likely to be adverse. And adverse variances generally demotivate managers because they have tried all their best and we are still saying variance is adverse. So we do not actually implement ideal standards in a direct way. How do we implement is this? It has it was introduced many years ago by the Japanese accountants and management consultants, okay, somewhere around in 60s. And aim was to improve in this way, which a number of companies say every little helps. If for example our wastage level at the moment is 10%, if wastage rate is 10% at the moment, there is no way we can bring it down to 0% overnight. But can we try and tell our managers, can you do something about it to bring down the wastage from 10% to 9%, and managers may accept this challenge. Bringing it down from 10 to 0 may not be acceptable, but 10 to 9% every little helps, okay? That may be taken up as a challenge by a number of managers, okay? That if we apply due care, due diligence, we can reduce our losses, wastages, idle times, or any non-value additions. So that's how the standards get harder and harder by a small margin. By a small margin. It's like ACCA. At the moment, pass mark is 50. Anybody who gets 50 marks is pass qualified candidate. What if ACCA sets the ideal standards in practice as well, that from now on, anybody who will get 100 out of 100 marks will be a qualified accountant. So I suppose I will be the one who is talking to myself only. I don't think anybody will be there to listen to my nonsense, simply because 100% marks is probably, I'm not saying impossible, but near to impossible, okay? So idea is what ACCA can do. I'm not suggesting ACCA, okay? What I'm saying is, if ACCA increases the pass mark from 50 to 55, I think a number of people may not even take much notice. A number of people joining ACCA, they will feel, yes, that's good. 55 marks is not impossible, okay? We still have a gap of 45 marks. So that's how the standards are made harder and harder, okay? Slowly, gradually over the passage of time. Second one, basic standards. Basic standards are very similar to ideal standards. They are also set under the perfect working conditions. So again, we do not implement basic standards directly. Basic standards are actually used to monitor how much of the ideal standards have been achieved over a period of 1 year, 2 years, or 3 years. So basic standards are used to monitor the trends. That when the ideal standards were set by the top management wants to see after a year or two, have we headed towards the ideal situation, or are we going to go towards something else? Are we going to go worse? We are not heading towards our missions. So basic standards are used to monitor the trends only, but they cannot be used because they become out of date or they are based upon perfect working conditions. Thirdly, attainable standards. Attainable standards are those which can also be called as achievable standards or realistic standards. Realistic standards means something which can be performed or done by the managers in a realistic environment. That there may be a fatigue, there may be a loss or breakdown. Sometimes suppliers may delay the deliveries as well. A number of times we go to buy any product and the shop or retail market or supermarket or online shop tells us, sorry, out of stock. Why they say out of stock? Because we are in the realistic world. A number of times we may not have enough to produce. So realistic situation is that it is efficient, it is hard and tough, but not perfect. Okay, so it includes the allowance for normal waste, breakdown, any fatigue, any demotivation or low morale or illnesses, etc. Okay, into the standards that things happen in life. Attainable standards must be based upon tough but realistic performance. Okay, what we believe is that tough targets generally, when I say tough but achievable, I'm not saying impossible. So tough or hard is still achievable. So managers are given slightly tough challenges because what we believe is that would motivate our managers and workforce. So tough standards are used for motivational purposes, and also attainable standards or achievable standards are used to calculate the variances. So they are used in the planning process and then in the budgetary control or performance evaluation purposes, that with the help of achievable standards we compare them with the actual results, and then managers can say, yes, I was given this achievable target. If I have achieved, I should be appreciated. If I haven't achieved, I'm sorry, I will try to improve things next time. Okay, so these are acceptable. Now here is variance analysis, basic variance analysis to be precise, because variances are divided into two categories: basic, which have been covered in paper F2, and now advanced variances, which I will talk through in a separate session, which are in F5. Variance analysis. So variance is simply a monetary difference between budgeted results and actual results. So variances are simply monetary differences between standard results and actual results, meaning what was the standard cost and what was the actual cost, what was the standard revenue, what was the actual revenue, and the difference between the two is called as a variance. Okay, variances can be used for cost control, because when the managers are given set targets or benchmarks, then they are likely to spend within the target. If they spend more than the target, then of course they are not doing justice to the organization. Secondly, they can be used to reconcile budgeted and actual profits. Reason is or contribution as well. Under the absorption costing, we reconcile profits. Under the marginal costing, we can reconcile the contribution. So, because as per standard costing, we have the budgets and standards, and as per the traditional accounting system, the financial accountants have the actual financial statements. So at the end of the year, when we compare the actual financial results with the budgeted or standard financial results, if there is any difference between the two, variances help us to reconcile profits. Variances may quantify the value of a known difference, that if variance has occurred, there must be a reason, and the value of the reason in dollars or any other currency, so that we can take a control action. Meaning, if the material usage variance is adverse, we can work out how much extra material has been used and who was responsible behind it. Okay, we can fix the responsibility. And then finally, in a number of organizations, variance analysis is successfully used to reward and blame the managers. Okay, so it can be a very useful performance evaluation system. Now here is, let's learn how basic variances can be calculated, which is like a revision of paper F2, but that would help us to understand advanced variances when we will start in a separate session. Okay, so here is an example. In limited, requirements are, which you used to see in paper F2, calculate the following variances. For example, material usage and price, labor efficiency and rate, variable overhead efficiency and expenditure, and fixed overhead efficiency, capacity and expenditure, and sales price and sales volume. So there are a number of variances we are calculating. Why do you think there are so many variances? Why there are 2 variances for the materials? Why there are 2 variances for the labor, for example? Simply because the performance appraisal or performance evaluation system, variances are used under the responsibility accounting. meaning that variances are not just a blame game, that we calculate variances and our aim is to blame the managers that you have overspent the money. No, the overall aim of the variances is to find the responsible person, whether somebody should be appreciated or whether somebody should be not appreciated or blamed for. Okay, reason is this, that material, if I just start with material, the cost of material depends upon two things. Number one, how much material will be used in one unit, and what will be the price of material per kilo, per liter, per meter, etc. And I think you got my idea already. Usage is the responsibility of one department, and price or purchasing is the responsibility of another department. And that's where this idea of so many variances comes along, so that we can find the right person who was behind the good performance or who was behind the poor performance. So usage variance is the responsibility of the production department, and price variance is the responsibility of the purchasing manager. Likewise, labor rate and efficiency. Efficiency is the responsibility of the production department, whether the production director or manager has utilized the workforce efficiently. And hiring and firing is the responsibility of the HR personnel departments of the company, because they are responsible to hire the people and set the rate per hour for the people. So two different departments. So this idea goes along, that our aim is to find the real reason of the difference. Okay, it's not just to blame the people, but in the better interest of the company in the future, we want to find who actually was responsible behind this variance and who was actually responsible behind that variance. Okay, now first of all, if we analyze the data, and then we will start setting up the pro formas for the variances. So I will show you some variances and rest you can try. Okay, example, Owen Limited. Owen Limited uses a standard costing system, meaning they record estimates. The standard cost card, and again before I move on, standard cost is always written for one unit. So standard cost card for one product is shown below. This product, whatever this product is, XYZ, this product has this much of direct materials, and can you see under the direct materials it says 4 kilos at $5 per kilo, meaning one unit of this product will cost us $20, whereby 4 kilos will be used in one unit and the purchasing department is supposed to pay $5 per kilo. If purchasing department pays more than $5 per kilo, we will blame them, adverse variance. But if the purchasing department pays less than $5 per kilo, we will consider it as a saving. If production department uses more than 4 kilos, we will say over usage or wastage. And if the production department uses less than 4 kilos, we will consider it a tight control on usage or saving of materials in the production process. This is how we develop different variances for each element. Same thing about labor as well, that one unit is produced in 2 hours and expected rate per hour is 8, and so on. The information goes like this. So standards are written for one unit only. So first block of information is the standard cost card. Okay. Second block of information, if we analyze it here, the budgeted output and sales was 1,000 units. So they budgeted to produce and sell 1,000 units, whereas actual production and sales for the period was 1,300 units. So they thought they would produce 1,000 units, but they produced more for some reason. Here is the actual cost and revenues for the period, which were as follows. Second block of information reflects actual results. Is that okay? Second block of information reflects actual results. Now please identify the primary difference between standard results and actual results. primary difference you might have observed by now, that standard cost was given for 1 unit, whereas actual results were given for hundreds or thousands of units. This is always the case in your exam question. Please remember, standard will always be given for 1 unit and actual results will be based upon how many actual units we produced or actual units we sold. Because if you look at the actual financial statement like income statement, you will not see the sale of 1 unit, you will see total revenue. You will see total cost of sales. So revenue minus cost of sales is the total gross profit. That's how you present to the shareholders. So actual results are always reflecting totality, whereas the standard cost is internal information which represents 1 unit value. Now here is my understanding. If I ask you a question, if I am calculating direct material variance, if I am calculating direct material variance, do you think it will make sense if I compare $20 of standard material cost with $22,700 actual material cost? I mean to say, do you think this will be the variance, which is $20 minus $22,700? And if I calculate this variance, do you think any manager will understand this variance? What do you think? I agree with you, no. Do you think any manager will accept this variance? Oh, brilliant. No, exactly, I agree with you. Because somebody can say, how come you are comparing $20 with $22,700? It doesn't make sense to me. Because it is not a comparison of like with like. We are comparing the cost of 1 unit with cost of thousands of units. How can it be made understandable? I will explain to you with the help of some pro formas. So please remember, it's all about the idea of like with like in every single topic. Because soon as we will start comparing apples with bananas, okay, people will simply do not understand. They will say, what's this? Okay, right analysis is this. If I compare standard cost of 1 unit with actual cost of 1 unit, is it okay? Or the other way around, if I compare the standard cost of thousands of units with actual cost of thousands of units, then it makes sense. Okay, and this is what we have studied in a separate session. Remember flexed budgets. Flexed budgets actually help us to compare like with like, but I will show you separate performance. First of all, let's calculate material usage and material price variance. Okay, so here is the pro forma we can use for the direct materials for ON Limited. Direct material variances. Okay, now idea is very first line is called as standards. Now I am developing pro forma or formula, you can call it, format you can call it. Very first line we develop is standards or standard results. Why the first line is standard results? Because right at the beginning of the year, all we have is our estimates. All we have is our budgets, or all we have is our plans or standards. So as the year starts, we have our standard results. So for the direct material, standards were written in this way, that 1 unit will consume, I can show you the numbers again, 1 unit will use 4 kilos and the price will be $5. So we can say usage was 4 kilos and price was $5 per kilo. Or in other words, we can develop the pro forma in this way, that 4 kilos represents quantity and $5 represents price, because 4 kilos and $5 are coming from the standard results, so we can attach a prefix to both elements as standard quantity times by standard price. Okay, and in exam purposes, to save this time, rather than writing down the full version of standard quantity times by standard price, we can make it up in short version as standard quantity or SQ multiplied by standard price or SP. Okay, so instead of writing the full version of standard quantity times by standard price, we can write down this is the SQ or standard quantity and this is the SP or standard price, just to save time in exams, okay, which is perfectly acceptable to the examiners. Every marker is an accountant and they know the meanings of this. You don't need to worry about this, okay. When we go to the end of the year, we achieve actual results. So here are the actual results, which you can call them actuals. And in actual results, we will have the same thing. We will have some quantity as per actual results and we would have some price as per actual results. So idea is that standard is replaced with actual, meaning this becomes actual quantity and this becomes actual price. So instead of S's, we use A's. So actual quantity times actual price equals to the actual cost of direct materials. And the difference between standard results and actual results gives rise to the material variance. Okay? The only problem is actual quantity and actual price are given in so many units. For example, we are provided 5,000 kilos were used, costing us $22,700, meaning to say actual quantity was $5,000. Now, do you think comparison between 4 kilos and 5,000 will be any use, or would it make any sense? No. What is 4 kilos and 5,000? Doesn't make any sense. Okay, right? So we will see how to change it. And actual price was not given. Instead of actual price, if I just change the color, this is 5,000. And actual price was not given. Instead of actual price, actual cost was given, which was $22,700, I suppose. But can we not work backwards to find out actual price? The $22,700 was the cost of using 5,000 kilos and the price comes to 4.54. So if it's not given, we can work this out as well. 454, mostly it is given. If it's not given, we can find out, okay, especially in multiple choice questions. Okay, now here is, for example, 4 kilos times 5 is 20 and actual is 22,700, and that's what I was saying, it doesn't make much sense. So what we do in order to make it like with like, always remember, first line of every variance, meaning the standard line of every variance, will be flexed by multiplying it into actual production. How many actual units were produced? And I think we seen in the question 1,300 units were produced in this period, which I can show you here. 1,300 units were produced. Okay, so 1,300. Now this is the meaningful calculation, okay, which is 1,300 units times by 4 kilos multiplied by $5, which gives us something like $26,000, I guess. Okay, and I think now it makes some sense in a way that we are saying 1,300 units should have cost us $26,000 in materials, but 1,300 units did cost us 22,700 units, and here we can see some saving, and manager can accept that $26,000 is the standard cost of making 1,300 units and 22,700 is the actual material cost of making 1,300 units, and this can be understandable. This becomes comparison of like with like. The difference between 26 and 22,700 is called as total material variance. Why we call it total material variance? Because it compares both quantity and price in one go. We are not interested in total material variance. Rather, we are interested in two variations separately, meaning one variation is the responsibility of the production department when we compare standard quantity with actual quantity, meaning how much we should have used and how much we did use. And second comparison is between the standard price and actual price, meaning how much we should have paid and how much we did pay. Okay, in order to make it separate analysis, what we do is from the left hand side, from the first line, from the left hand side, standard quantity is changed to actual quantity, and we do not touch the standard price. We just keep it as it is. Now, in idea is this, that lines number 1 and 2 compare standard quantity and actual quantity, keeping the standard price and standard price constant, meaning lines 1 and 2 will not give any difference in price, they will only give us difference in standard quantity and actual quantity, and this is called as usage or quantity variance. Whereas if you compare lines number 2, if for example, if I define this is line number 1, this is line number 2, and this is line number 3. If you look at gap between lines number 2 and 3, you would notice AQ and AQ are constants, meaning there is no variance between first AQ and second AQ. The difference lies on the right hand side, which is the comparison between standard price which we should have paid and actual price which we actually paid, and the difference is called as the price variance. Okay, so let's calculate all numbers now. Okay, actual quantity was 5,000 kilos and standard price is $5. So answer for the line number 2 comes to $25,000. Now this variance 26 minus 25, which is $1,000, is called as favorable usage variance. And you know why it is favorable? There are two ways to identify. One is slightly more analytical and second is slightly easier one. Why is it favorable? Easier one is this, that 26 minus 25 gives rise to a positive value on the calculator, and what we believe is positive variances are favorable. This is an easy approach for the exam purposes, that you don't need to think much. Usage variance is favorable. Materials were saved in this period. Second is more analytical way, which is this, that if standard quantity is 4 kilos in 1 unit, can we say in order to make 1,300 units, we should have used 5,200 kilos, 1,300 times 4 only, 1,300 times 4 gives us 5,200, whereas actual usage was only 5,000. Can you see a saving of 200 kilos? and that gives rise to the usage variance. Okay, so understanding is whichever way you go along, okay, just make sure you need to finish the questions in time. So my recommendation is go through the easy steps rather than looking into the difficult ones. Okay, now let's have a look at the lines 2 minus lines 3. Okay, 25,000 minus 22,700, we get a positive difference of, I think, $2,300. And because it is positive, it is favorable, and it is called as price variance. Price variance. And second is slightly analytical way. If you look at standard price, standard was to pay $5, whereas actually we paid less than the standard, so it reflects a saving for the organization, and that's why it is favorable. So with the help of individual variances, we assign the responsibility that production manager contributed $1,000 to the company profits and purchasing manager contributed $2,300 towards company profits, meaning actual profits will be higher by 1,000 from the production side and 2,300 from the purchasing side, or in total actual profits will be $3,300 more than the budgeted profits. So we can reward them accordingly. If somebody has contributed more, we can reward them more. If somebody has contributed slightly less, we still appreciate, but of course our rewards are based upon proportionate efforts. We don't reward everybody uniformly, because uniform appreciation also demotivates some people. Now here is the same idea in terms of labor cost variance. Exactly the same idea, but for the labor cost. Let's repeat the things. First of all, we develop first line, which is for the standard results or standards, and last line reflects actual results or actuals. And for the labor, if I go back to the information again, this time my whole focus is on the labor. As per direct labor, I am given that one unit will take 2 hours to produce and we will pay $8 to the workforce. So can I make it like standard hours which are 2 multiplied by standard rate, which is $8, okay? Hours and rate, because we are picking up information from standards, so it becomes standard hours times standard rate. And again the similar principle. In order to save time in the exams, we can make up like standard hours or SH multiplied by standard rate or SR. And similar principle, when we receive the actual results, hours and rate remains the same, only changes S is replaced with A. So it becomes actual hours multiplied by actual rate. Okay, and similar principle, because we want to see the performance of 2 departments, one is the production and one is the rate or HR department. From the left hand side, standard hours are changed to actual hours and we do not touch the standard rate, and automatically on the right hand side we end up comparing standard rate with the actual rate. Okay, and before we forget, first line of every variance is multiplied by the actual production. Actual production units, okay? So understanding is this. Standard hours were 2 and standard rate was 8. And remember, actual production was 1300 units. In this period, in this month, we produced 1300 units. Now so can I copy and paste this standard rate here as well, which is 8. Now I'm looking at the actual results about labor. Actual results about labor show that 2,850 hours were worked by the workforce, costing us $21,500. Okay, so 2,850 hours were worked, costing us $22,800. $21,500, sorry, $21,500. Can we not calculate actual rate paid to the workforce? Simply divide 21,500 over 2,850, which gives us approximately 7.54. Okay, it's slightly more average rate, but 7.54 rounded off. Okay, now we can work out all lines one by one. Okay, so 1300 units should have cost us something like 20,800. Second line is 2850 times by 8, which is 22,800. And third line was given already, copy and paste, 21,500. Okay, so lines 1, 2 and 3. Difference between lines 1 and 2 will compare standard hours with actual hours, meaning how much time we should have spent on 1300 units and how much time we did spend on 1300 units. So the difference between lines 1 and 2 generates the efficiency variance of workforce, which is, I suppose, adverse or unfavorable. Okay, which is negative $2,000. In exams, you don't need to put down negative or positive signs. I am just explaining that if it comes as a negative figure on your calculator, 2800 minus 22,800, very quickly it is adverse. Okay, it is adverse. Or a bit more deeper view, that 1300 units should have been produced in 2,600 hours. I mean, if one unit should take 2 hours, then 1300 units should take 2,600 hours, but actual time was 2,850, meaning actual time was more than our expectation, meaning either workers were slow, or workers were less motivated or demotivated, or any other problems, idle time, etc. Okay, something. But time was higher as compared to our plan. If we compare lines 2 minus 3, we end up with 22,800 minus 21,500, and it gives rise to a positive $1,300. And positive means favorable. And this is called as favorable, not the price, rate variance. And you can actually compare as well. Standard rate was $8 and actual rate paid was slightly lower than the standard rate. And I think that can also give me some more understanding why efficiency was adverse. I suppose if you were committed with the management and management expected they will pay you $8 at the beginning, but at the end, if only $754 is paid to you based upon this information or knowledge, okay, I think a number of people, they may be demotivated. A number of people may lose interest in work, and a number of people may not actually like to work as per efficiency levels. I'm not saying everybody, but a number of human beings, okay, and that's the meaning of the labor cost variances. Okay, likewise you can develop variable overheads, fixed overheads and sales variances as well. Okay, because these were the basic variances. I just wanted to show you a little picture how basic variances work. We will spend more time on the advanced variances because those are precisely in our syllabus. Basic variances are not in our syllabus. Okay, so we will end this session right here because I think almost everybody should be okay about basic variances. We have bridged up the knowledge gap, and this knowledge will be used in our advanced variances in a separate session. Okay, so please watch this again, read from the study textbook, and I'll be waiting for your feedback. If there is any problem, please get back to us. Okay, all the very best, take care and goodbye.